Welcome to the Broken Pie Chart Podcast, episode 373. I'm your host, Derek Moore. With me once again, Mike Snyder and Shane Skinner, or you can invert the names, whoever you want to name first there. All right, lots to talk about this week. We were talking offline, and I just came back from the CBOE RMC. That's the Risk Management Conference. They held it in Nashville. Really good event. And it was fun because you're in a room or multiple rooms with people who run option strategies, who are in the options business. And I will tell you, thinking about is it a melt up? I don't know if it's a melt up. Okay, we've had a V recovery, had another one. And one of the things that was, people like us who were in the options world, and we could see it. We started to see it with some of the skew numbers. And I almost think that people were hedging this upside move and hedging in a way that said, if it's a V recovery, I don't want to miss it, or I've got short positions and I don't want to get blown away in case we see the real powerful reversal. Shane, I'll come to you first. I mean, I feel like this goes to dealer positioning where people are long calls. The dealers, meaning the market makers, have taken the other side, which they normally do. They trade when they step in. They don't necessarily want to take long or short positions. They want to be neutral. But when they have this stuff on the books, as the market is going higher, the deltas are increasing in what's out there on the street. And therefore, to hedge and remain neutral, they have to buy more shares. Like, to me, Shane, this is textbook. And plus, the short stuff, the long puts that were out there, the deltas are dropping there. And all that means is market makers got to buy stock. Like, to me, this is textbook.
Yeah, institutional flows is an even probably broader way to summarize it. But I just think that you saw a massive amount of institutional flows between the market makers' books having to buy to hedge higher. And then I think we saw like a record pace, according to Goldman here, looks like systemic funds buy stocks at record pace, adding 86 billion. That came out this morning on investment.com there. But systematic hedge funds have snapped up equities at unprecedented speed over the past week, adding 86 billion in exposure, according to the Goldman Sachs published note late Thursday. So it just sounds like you had massive heavy flows coming in on one side of the market, and the book probably got way off sides. I mean, what was this in terms of a move? This was like a 99.99% tile move here, sort of the past 10, 14.
Meaning moving this far up this fast or over so many days is, if you think about the bell curve, it's way over on the right.
Yes. Exactly. So yeah.
I mean, we kind of made the joke. It wasn't a joke. Can I do it? Not a joke. Didn't we have a president who said that? So is the market wrong or the analyst wrong? And so far, the analysts have been right, meaning they kept raising their earnings estimates even as the market was moving lower. This so far, and I'll let you know when I know in a couple of months whether this continues, whether we go back down. I mean, who knows? But analysts were not afraid of just continuing to raise their estimates. We see earnings coming out. Earnings have been good. Seems like the street likes what companies are saying. The banks came out. I think all the banks but Wells Fargo had a beat on their earnings. I mean, Mike, it's, to me, and what sort of strikes me too, what Shane just said, these people are coming in and buying stocks now. Like, you could have bought stocks really on sale 2 weeks ago or a week ago, whenever that was. And they didn't. Now you're buying.
Yeah, I also saw Bank of America said something about a significant amount of, checking accounts and cash being removed, in theory, also going into the market. So, I think these types of market mechanics that we're talking about is really what extends rallies. It also, worsens sell-offs. you need the underlying news to be the engine that starts it all, and we got that, right? We got news about Iran, oil sold off, and the market rallied, but it has extended and continued. It's up like 13% off the low. So yeah, no, I think that's a great point.
We think about earnings next week too. It's going to come. It's fast and furious now. So we got IBM, Tesla on Wednesday. Maybe we'll take a look at Tesla's options later. You got Boeing, United Healthcare Tuesday morning. Boeing is Wednesday. I don't know if Boeing's is as important as they once were, but sure, they may say something. Intel is like back from the dead. Good for them. I mean, that stock was left on the side of the road, and somebody could have picked it up for pennies, and now it's surging. Yeah, I mean, we're starting to get into it, and I think it's the following week. That April 30th, yeah, it's right around the April 30th period. I think we'll have Apple and some of the other big ones. They tend to cluster around. But yeah, I mean, I look at this, and this is why it's so difficult to try and time markets. And I know everyone knows that, but it's like, really? Because when you talk to people 2 weeks ago, everyone's saying there's no way that markets can go up. And same way 2 weeks prior to that, people said, well, there's no way the market's going to come down. And markets have a forward-looking view, and right now, its view is interest rates are going to come down. You remember a couple weeks ago, the Fed funds futures were factoring in a rise in rates. It's like, really? And what else? It's looking past the stuff with Iran. I mean, we'll see where that all ends up. Weekends seem to be where a lot of the progress or non-progress happens. I feel like Trump knows the market's open sometimes when he sends stuff out. He wants the markets to go up. And then you continue to have earnings. So, look, I mean, it's 7,100. I mean, did we close above 7,100 today? I think we did, right?
Yep. Mike and I were literally in our morning meeting this morning talking about everything you just said. How basically we've gone from rate cuts were for sure coming to they're not going to cut to they're going to rise. And now it's like the market's almost thinking, okay, they're going to cut again. They have an excuse to cut again. And the oil thing, it's coming back down, right? I think we broke 80 a barrel on the futures on the active month today. I think our oil was like 78 something a barrel. You said it's forward thinking, and what if forward estimates and then you had bank earnings come in this week too, so you've got all that going on, and I think the market is just out of that window of sort of the only thing that really seemed to be in the news was what was going on in Iran, and like Mike, wouldn't you say like it's we're kind of past that? There's other things that the market's paying attention to now.
Yeah. Oil in Iran was the news cycle, and now that there's earnings, there's numbers, there's estimates, there's company leaders evaluating the short term, near term, long term of their businesses, and it's given the market numbers again to digest.
Going to give you some numbers. Speaking of those, the forward estimates now on the S&P 500, 326.58. Estimating over the next 12 months, growth of 17.64%. The year after, 15.16%. The year after that, 10.8%. Forward estimates, we're trading at 21.85 times. At one point, we were over 23 times forward. The market came down to, I think it came down to about 19.5 times. Earnings have gone up more. Valuations have gone back higher, not as high as they once were. The other thing I just have to point out is if you look at semiconductors, and semiconductors basically were sort of flat for a while. They are just, they're running again. If you look at a chart, you look at a chart of SMH, for example, and you go back to, I don't know, end of December through probably the very end of March, even the beginning of April, it was sort of flat. So I don't know. I mean, we talked about semis, the SOX index, the earnings, the analysts are expecting 80% growth in earnings over the next year. And you could say, well, okay, that's already priced in. The market is discounting that there's going to be growth this year, maybe next year, and then it's going to peter off a little bit. Like semis were, I mean, they did their run early. They missed some of the run of the other, certainly the Mag 7 and the other ones. They're taking off again. So I'm going to use SMH as a proxy. It's 464.16. Like, does this thing keep on running? And, don't trade off this. Just kind of a discussion we're having. Like, are the semis, I mean, are we in for another like big run in the semis? Mike, any thoughts?
Yeah, I could see that happening. It's sort of a higher volatility play, obviously, than when you're just looking at the broader market like the S&P. And so you'd expect that if the market runs that, this index should outperform it. And like you said, there was a period of time where it was pretty flat. So I could see there being some more catching up to do in terms of its upside.
I'm just checking the forward 12-month estimates on, I guess we can look at the SOX index, right? That's the semiconductor index. Let me just get the right one. I was looking at the ETF, which of course, unless you have certain software, you don't know what the forward estimates are for that. I mean, 84.68% growth expected in earnings per share. Sales per share expected to grow 33.5. I mean, you also had Taiwan Semiconductor come out with good earnings. I think they said some positive things. And they make all the chips. Like, people forget that. NVIDIA, I don't believe, makes any chips. I don't know why Taiwan Semiconductor isn't the most anticipated stock, because right now it's all about chips. And if they're making the stuff and they tell you they're doing well, that bodes well. I mean, look, you're not early if you're looking at semiconductors. You're not. I mean, they've had a breakout already, and if somebody who wants to maybe do a trade here might buy one of the ETFs, maybe hedge it. Or here's the thing, Shane, you already own this in the SPY. Like, you already own this in the index, so you're participating in it.
Right. I mean, that's the whole point of being in it. And who could have known that NVIDIA, 10 years ago, NVIDIA was a video game company. That's how we knew it. I knew NVIDIA from if I wanted to upgrade my PC so I could game and run charts at a faster rate, I would go get a better, NVIDIA chip. That was pretty much about all. And maybe the Bitcoining mining industry, right? Maybe you had some demand there, but gaming and that weren't much. Now here we are. Is it the largest company in the world right now, I think, right?
Oh, we got to check. No, I don't.
I don't want to make that statement. I don't know if it is, but also what I'm getting at too is like, you don't know. You don't know when one company is one thing and turns into another. You don't know who's going to be leading. 10, 15 years ago, software as a service names was a huge area of the market for people to get in on. And it saw tremendous growth over the past 10 to 15 years. And you look at the recent drawdown on the market, I know we can attribute it to a multitude of things. It's not necessarily just one thing, but the software as a service sector, due to all this disruption from AI, it's pulled back 20-30% from its peaks on a sort of sector level. And some of the names in this sector have pulled back 50-60% from their highs, some even more, right? And I'm not saying buy or short. I'm not saying anything about it, SaaS, but what I'm...
Are you a buyer here? You loading up? Is that what you're doing?
I think the market might have overestimated it. It also, too, it brings me to this, and I wanted to ask you this question, was So the software as a service sector has taken a big hit because of all these potentials that AI poses: Anthropic, Claude, ChatGPT, OpenAI. At that point, if those companies are going to consume a good chunk of the existing SaaS business or market, when those companies go public, which we're anticipating they might IPO this year, right? We're talking about how crazy these valuations on some of these names are. Is it justifiable when you think about the fact that it might completely replace entire sectors of the market at some point? Maybe.
I mean, I can't wait for these S1s because I haven't seen the books. I don't know what it's rumored what SpaceX, what Anthropic, and what OpenAI's revenues are, whether they have earnings, whether they don't. But I'll be very curious to see the S1s. I feel like Elon was smart in making it known or filing right after the Artemis 2 mission, which I've seen those pictures. It's like unbelievable, the pictures from the backside of the moon. It's pretty cool. So, yeah, I mean, by the way, NVIDIA, it reclaimed the number one spot. I thought Apple was still there, but looking at it now, if I look at the holdings in the SPY as of yesterday, NVIDIA was about 8% of the S&P, Apple about 6.4%. I will tell you too, according to Bloomberg, 4.9 billion, and this is in billions. Yeah, so 4.9 trillion is the market cap right now for NVIDIA. So I guess the question is, when does it get to 5 trillion? Does it get to 5 trillion?
If you're going to continue to see the investment in the CapEx, think about it this way:
so is it going to 5 trillion or not?
Nobody make any position.
No, I'm putting you on the spot. You're only 100 million away.
No, it's going to go to 5 trillion. It might go to 10. It might, and you're going to call me nuts. But you got to, if you've spent, which I know you've messed around with it. I think Mike's messed around with it. I don't know if our users have, but if you've messed around with some of the capabilities of these AI software and applications out there, it is pretty incredible what it's capable of. And so I think it has to be acknowledged that there is the potential for a small number of names in this space to take over a good chunk of share.
Right, you haven't answered my question though. Is it going to 5? If my math is correct, if it goes up $4.12, it gets to 5 trillion based on the shares outstanding.
Going to 5 trillion. I said it probably goes. So.
Yeah, I mean, look, it's fascinating though because NVIDIA had kind of fallen back. I think Apple, probably Microsoft had passed it too. I think they got to third. Now they're for the audience: NVIDIA, Apple, Microsoft, Alphabet. You always have to do math. Actually, Alphabet is 6.62. So they would be the second biggest if they didn't do this dumb thing about separating into A shares and C shares. But yeah, Mike, it's like
go ahead.
5 trillion. What do you have to say about it?
No, I think short term, the risk in semiconductors, NVIDIA, I think Taiwan Semiconductor and their earnings sort of highlighted it. They beat on virtually every number and provided stronger guidance than, the street was expecting. And the stock actually sold off after earnings were reported. So the expectations for these companies are extremely high. You can't really just hit the expectations at this point. I think when you do that, it sort of becomes a sell the news type of event. So I do think earnings have to continue to come in even stronger than expected for them to move up in the short term through this earnings season.
Mike, you might remember, so back in 2000s, it wasn't good enough for them to just beat earnings. They had to beat the whisper number. I don't know if you remember that. It was like they'd say, the number to beat is 50 cents, but the whisper number is 60. And if they came in with 58, the stock would sell off.
Right.
That was a big deal for a while. No, I mean, it's a good point. And here's like the bear case for semis. the bear case for semis is all of the valuation, all the expected growth is already factored in. And you know that, I mean, if there's any sort of a downturn, if there's any sort of a hiccup in the momentum of AI and all that stuff, and demand goes down, we've seen that before. We've seen, by the way, we've seen Nvidia go down 50%. So absolutely. I mean, we don't know whether this is going to keep going or not. It seems like that semis, though, I don't know why they traded sideways for so long. It was kind of interesting, but they've been early on things. They were early to break out, early to consolidate, and we'll see. I mean, the whole market's kind of breaking out now, but I don't know.
Do you have laws against? I mean, look at what happened to SMCI, right? For backdooring chips illegally, breaking the law. Like this, it's a national interest that this continue to further. So wouldn't you think that? That's not to say the stock can't pull back, but it doesn't seem like the markets or the economy or where we're headed is turning away from AI, right?
No, no. I think that's a fair statement. I mean, it's yeah. But remember, though, in the classic model, it's a lot of times, the classic thing, the Carlotta Perez's technological revolutions in financial capital. The model is, and you go back to railroads, to the internet, to all these different things. There's booms and bust. There's speculation. A lot of times you have a period of a bust, but the standards are set. Standards are set, meaning there's a single standard. And then you see the winners emerge, and it eventually accretes down to kind of the old economy. And we saw this with the internet, where old line companies started adopting the internet, but nobody remembers Netscape anymore. Nobody remembers some of the companies that went boom and bust, but they may not have been successful, but the technology endured. So yeah, I mean, AI to me, like, I don't know. I'm totally just sort of giving a contrarian opinion. Like, I don't know if OpenAI is going to be something that survives. Maybe they will, maybe they won't. I have no idea. I don't see their books. We'll see what the S1 is. Like, you never know who's going to be the winner. And I go back to what Cameron Dawson said when she spoke at the CFA Society dinner in Phoenix. God, that was that a month ago? It feels like it was longer. What was Google, like the 7th or 17th web browser? And they wound up being the winner. So you never really know who's going to be the winner there. So
right. Yeah. Goes back to own the market.
Just own the market. Just don't try and get too cute here. Okay. Let's think about Tesla. I want to go into their stock a little bit. Like Tesla, I feel like a lot of people are playing this because there's a rumor that they might merge with SpaceX. And so if you have Tesla, maybe you get SpaceX. I don't even know how that would work, whether it would be good or bad. Like Tesla was in a downtrend from the end of mid-December, and the most recent low was what? April 9th. So it's caught a little bit of bid here. If I look at their options market, and options, would we say it's next Thursday or Wednesday? I forget which day I
Wednesday.
said. Okay, so I'll look at next Friday's options because that will incorporate that. So we go to the...
Isn't that awesome? We have multiple expirations in a single week on an equity.
They talked about that at the CBOE conference. Like, we're seeing that.
Coming. Yeah.
Well, I mean, just the fact that we're seeing it. I wouldn't...
Right. We'll see.
So 400, closed 400, spot 62. All right, Mike, so I'm going to put you on the spot here. Why not? All right, so the implied volatility right now is about 57 on the 400 call and the put. So the straddle cost you, if you buy the 400 call, you buy the 400 put. And I always say this is a dangerous trade because this is a volatility trade, meaning the market has to move a lot. But Mike, just if I look at it, it's what, 1332 and 1232 to 25, call it 25.75 is how much it needs to move up or down to break even, right?
Yeah, it's like a 6% move.
Okay. So are you now the other side of this, and really don't try this at home. This is even more dangerous of being long the straddle, is you could short the straddle. And if the market doesn't move enough, that person makes money. They lose money if the market really moves. But of course, just being short the straddle, you means you have unlimited loss to the upside. So Mike, are you a buyer or a seller of the straddle? Let me get my pen and tell me how many I could put you down for.
6% seems a little light for Tesla. I was expecting it. I was expecting it to be a bit more.
I was too.
So, if I got to do one, I would be buying it, but I will be doing neither, just to make that clear. But if I have to do one, I'm buying it.
I feel like I should take the other side. Yeah, I feel like I should take the other side then. Well, yeah, I mean, this is one of those things for options traders. When people first learn options, they say, oh, this is easy. You know it's going to move around earnings. I'll buy both a call and a put. And when it moves, I'll make money. But it's like the market already is factoring this in. When we say a 57% implied volatility, to kind of put that in a little bit of color on it, 57% implied volatility basically is implying a one-day expected move, one standard deviation move, about 3.6%. So, think about that. If I was to look at, I don't know, SPY options, just to kind of level set the playing field for next Friday. And I'm going to use the same one. So what did I say? The 24th? God, there's a lot of expiries here in these. So closed at 710.14. By the way, get your arms around that. SPY closed above 710 today. It was quite lower than there.
Still trying to wrap my brain around it.
Well, the implied, let me see if is this right? Implied volatility is 13 on SPY.
Yeah, I'm seeing that.
That's come down. There's been a little bit of a vol crush, Shane.
Yeah, VIX, didn't we say VIX finally gave today? What did VIX close at?
Yeah, I mean, VIX has kind of been hanging higher than we thought it should have, but I think there was that embedded.
You would have thought 15, but yeah, you're right. Like there's stuff that
1748.
Yeah, 1748 with a low on the week. Today, the low of the week was 1687. So
right, but that's intraday the low. I mean, we closed lower than February 25th. This is the lowest close since
like
February 11th.
11th? Yeah.
Yeah.
Yeah. No, I mean, it's huge. I by the way, not that you asked, but I would sell that straddle on the S&P for next week, and it goes back.
I'm totally buying it. I'm buying it now.
All right. Yeah, I mean, that's probably the surest signal you've ever been given.
Yeah, don't do any of these trades, really.
No, please, no, nobody ever, please. But
we talked about too how
maybe we get some sideways next week, right? Maybe this calms down. It's not that it goes down, but it's not that it keeps melting up. But you never know. These breakouts are violent sometimes, and they can continue way longer. Isn't the old saying like, "There's no way it could keep going up," right? There's no way it could keep doing what it's doing, and the market loves to do that.
Market loves to go where it goes. And what I would say is, this is one of my sayings: stuff matters when it matters. Apparently, the Iran conflict, war, whatever we want to call it, that no longer matters. Inflation doesn't matter. That it's thought to be transitory. Earnings matter now. Earnings didn't matter a couple weeks ago, but we live in a different world than we did just 3 weeks ago. Anybody name the movie? Draft Day.
Draft Day.
Yeah, watch the movie. That's a good movie. Draft coming up. That might be my recommendation this week. Watch Draft Day because the NFL draft is next week. Stuff matters when it matters. And when it doesn't matter anymore, the market moves on to something else. It starts to worry about the next thing. Mike, we talked a couple weeks ago too about just clearing up, Powell leaving, Kevin Warsh coming in. Did I see they're scheduling hearings for him now?
I think I saw that too. Yep.
So he gets in, and then historically the Fed chair gets what he or she wants. So, Mike, how soon after Warsh takes over do we see a quarter point cut?
I would bet it's going to be pretty soon, under current market conditions, as they would say.
I mean,
that's why he's being put in there. I mean, I don't see a world where he goes in there and his the reason that he's being put in there is to lower rates. I don't see a world where he doesn't do that pretty quick.
April 21st, that's Tuesday, he's scheduled. His confirmation hearing is February 21st. So is that in front of the full Senate, or is that just the committee? No, that is just the Senate Committee on Banking, Housing, and Urban Affairs. Why don't they separate those into 3 different committees? Why is the banking talking about urban affairs and housing? You think they would have, that must be a long meeting. I'm just saying.
That's why we don't work in government.
Yeah, well, apparently the hearing was initially delayed for paperwork. I don't buy that one bit. So, okay, so he's going to testify Monday, Tuesday, and then they'll send it to the full Senate for confirmation. Who knows when that will be? When is Powell's term up as Fed chair? I think it's coming up. Is it May 20th, 21st?
Next month. Yeah, right before, I think, Memorial Day, right around there, right?
Yeah, let me look at the end date though. So actually May 15th, even sooner.
Oh, nice.
Yeah, so they need to get going with this. So he'll come in. I think that's the only chair that's open, because was it Bostic? He was stepping down, but that's he was the president of the Atlanta Fed, and the Atlanta Fed will just nominate somebody else to replace him. So some of these are permanent voting members, and some of them are just, they rotate around the regional banks. So,
do you think that they cut 50? Do you think there's any type of world or possibility they cut 50? And not because things are bad, but because they think that we should have cut longer ago, and they just do it?
Well, I'll never say never. I mean, I think 25 is in there.
25 seems to be, I would agree. I'm wondering if they don't, like, the shocker isn't that they cut, but they cut more than people thought they would. They're even more looser than expected, which I'm not saying would be a bad thing.
Here's what I would say, Shane. And, Jerome Powell, what he did was telegraph everything. I don't think there was one time, except maybe when they raised 50 basis points instead of 25, where the market was a little bit unsure. Like, you just see it in the Fed funds futures. I don't think they guided differently. What we don't know is what Warsh is going to do, how much he guides. And we're going to have to see. Like some Fed presidents, Fed chairs, I mean, Greenspan, you never even knew what he was saying. It was gobbledygook what he would say in front of Congress. I mean, no one even knew. This is going back, but CNBC used to have the briefcase indicator. I don't know if you guys ever heard of this, but Greenspan used to be walking into the Fed building, and they came up with this briefcase indicator where they were going to make a move if his briefcase was really stuffed, and if it was thinner, there was going to be no action. And back then, there was no press conference. There was no releasing minutes. There was no, any of this stuff. They would just do it. So you guys are too young to remember that. But I still remember Mark Haynes, Joe Kernan, David Faber. They'd have the tape of Greenspan walking and be like, oh, it's really stuffed today. Even better if there was a paper sticking out too. You knew it was big action that day. So, wow. I don't know. Warsh, we'll just have to see. I mean, Powell definitely telegraphed things to the market. So wasn't really a surprise. To answer your question though, Shane, like, yeah, why not? Like Mike, I could see Warsh coming in and saying, we wanted to see, okay, let me play Kevin Warsh for a second. It made sense for the Fed to pause based upon the war in Iran. Now that that's done and we're seeing inflation subside, oil prices subside, to keep the economy strong, we feel it's best to do a 50 basis point cut, which probably would have been done earlier had it not been for that. Like, Mike, that's okay. How did I do there? That's Kevin Warsh.
That's pretty good.
Yeah.
Yeah, I'm buying it. No,
Does
I guess there's a world where that happens. I think there's an outside chance that it's 50 right away. I don't even know that I would say the first meeting it's going to happen. But yeah, you can argue for it.
All right. So Shane, I would, let me look at the Fed funds futures because I'm always curious about this after today. So I'm going to Bloomberg and I'm just going to see, okay, what are they pricing in? And I will tell you, there are no cuts priced in. So let's see. Yep. Well, the implied rate, I think they have it. The effective rate right now is 3.64. The effective rate they have at 3.64 for the April meeting, which is, I guess they do have one more meeting with Powell. That's on the 29th. I don't expect anything there. But then, about 3.45 by March of 27. I will remind people, though, these change all the time. Like, you look at this last week or 2 weeks ago, and it was saying there was a raise. So it's not pricing in a cut right now.
No, is it pricing in a raise, though? I don't think it's pricing in a raise anymore.
No.
So what'd you have? You had the overshoot into they're going to raise now, right? And that pulled back. So, let's give it one or two or more of these podcasts, and we'll see if we come back and now they're pricing in a lower move. But could you make the argument that either no 50 or no 25, they either hold? Probably hold at this point. I don't think that he's going to raise, but this is a guy who sort of earned his stripes in 2008. So, he seems like someone who's got the credentials, knows what he's doing, has been a part of this for long enough to where it's not like they're putting somebody random in here. Like, it seems like they're putting the Fed in good hands, and regardless of how it goes, we hope that they do what's best for, the economy and what's needed. I
got to be honest too. I don't think interest rates matter as much as people think. Remember, you had zero rates for years after the 2008-2009 crisis. We had zero inflation. I still don't think they even if they didn't raise rates due to the supply side issue that caused inflation in 21, 22, it would have come down on its own. All you did was stop housing, really. And okay, maybe that's a fair point. You could have stopped housing, but all right. One of the things I saw too, I wanted to bring up, NASDAQ 100 set for longest winning streak since 2013. This is from Bloomberg. Tech-heavy benchmark is extending gains for its 13th consecutive session. And let's see, includes April 17th intraday trading data. So that's today. Okay. So yeah, 13, is that right? 13 trading sessions in a row? That's kind of good.
It's the longest since when, you said?
2013.
13 sessions. 2013, that was 13 years ago. That's a lot of 13s.
It is. I smell
13% higher.
Stop.
Yeah. This is kind of the roulette fallacy, where just because you had 11 or 12 reds in a row, that the next one has to be black. Like, yeah, markets can do this. Apparently, they did it in 2013. So,
I got my license in 2013.
Yeah,
that's crazy to think, though. Isn't that awesome though? How markets, like, I think I sent it earlier in the week. I think in the past year, it's Zega. I've been a part of more quote unquote like record breaking things in the market than I think I'd experienced the 5 years prior in my career. And like, that's the beauty of markets. Records are meant to be broken, and the market seems to find a way to do that.
I mean, I remember in 2002, we have 2 down years in a row. And, the dot-com crash, starting in March of 2000. We had 9/11, 2001. And so you come out off those 2 years and you say, well, markets are very rarely, I remember the articles, very rarely or never down 3 years in a row. And we were down 3 years in a row, basically. And if you look historically, that really doesn't happen, but we were. And it just goes back to, like, nobody knows anything. And for all these people saying this never happened, this will happen. History does repeat itself sometimes. And we go back to the midterm year. Mike, typically midterm election years, the first half are down, the second half are up. So, and I think, what was it? Why can't I think of his name? Tom. Who's the guy? He runs Granny Shots. Why can't I? Tom Lee. Like, wasn't he saying the same thing? He's like, I think we'll have a retracement first half a year, and then we'll close much higher.
Yeah. He literally just came out and it's kind of played out like he said, and a lot of people mocked him, didn't they?
They did. Didn't mean he was going to be right or wrong.
But he got the retracement.
Mike, you've seen the numbers. Since Kennedy, the market's never been down a year after the midterms.
Yeah, I mean, but this goes back to how difficult it is to time and to sort of know what's going to happen in the short term. Like, think about what had to happen for the market to actually trend lower, right? We needed some sort of event that no one really saw coming for the market to make this move down. Does that have anything to do with midterms? I don't know. Maybe it does, and I'm just not seeing it, but it happened to happen during a midterm year. And so that trend is playing out.
Yeah, it's just textbook, though, this whole move where people started to sell at, I'm not saying everyone, I'm saying people who sort of make decisions based upon what they're seeing in front of them. And you see with institutions too. I think, Shane, you talked about the hedge fund flows. It's just uncanny. People were selling the most when the market was bottoming. And now all of a sudden that it's up, now they're like they don't want to miss. They're like, oh yeah, now everything's safe. And I could say the same thing about January of 21. Everyone was buying. Everyone was just coming in and buying there. And they were buying at sort of what turned out to be the wrong time. So, Mike, I guess the other thing too is a lot of people say, keep dry powder, keep some cash on the side. So when things go on sale, you can buy. Yeah, I mean, you could do that. And that's actually a strategy where you could take a portion and leave it in maybe 3-month treasuries or something like that. But I don't know. I mean, this is, when you look at a market like this, I also think, and people sometimes forget, Mike, 2022 is a bear market. Like, not all of these recoveries are V recoveries, right?
Yeah, that's right. They're not all V recoveries. I think when you think about dry powder, you want to think about how much dry powder you're keeping. That's the most important, right? Because odds are you're going to end up actually missing out, even if you get in on a sell-off like you did. If you've had dry powder for over a year, the market was still higher than it was, back in July of last year during this downturn. So, keep some dry powder. Maybe position yourself to, if you can hedge instead of having dry powder to dampen some of the volatility during a time like this. Maybe profit off of that hedge and reinvest that back into the market. But you do want to position yourself, I think, so that you're not forced to sell, whether it's for emotional reasons or for, financial reasons when the market sells off, right? You want to position yourself in a portfolio that's going to be able to withstand the downside so that you can withstand the downside and not be forced to make a decision at the wrong time. You can't just think about the upside, I guess is what I'm getting at.
No, it's a fair point. I want to stick with this NASDAQ 100 longest winning streaks. This is from Ryan Dietrich. And apparently when the NDX win streak of 12 days or more since 1985, returns are pretty good. So he put this out. There's 1, 2, 3, 4, 5, 6, 7. There's 8 times NDX, the NASDAQ 100. That's the QQQ for the home gamers. Have 12 days or more winning streak. The average a month later is 1.3%. 3-month, the average is actually down. But then 12 months later, it's 19.4. And you look at these win streaks. So the last one was July 24th. I don't know if that's when it began or ended. 12 days, 12 months later, 24.7. The worst one was January 9th of 1992, 13 days in a row, and 3.9% higher. I got news for you, though. Most years, the market's higher. So you have to start with that. But I guess what Ryan Dietrich's research is saying here is, okay, 1 month, 3 months, even 6 months sometimes, it's a little unclear. But a year later, historically, and I'll let you know if this is the case, let's somebody bookmark this and ask us in a year. Markets go up, they're in motion. It seems like it can be pretty good until it's not. Like, here's the thing. Nobody ever follows up with these charts and says, oh yeah, remember when I posted that? Actually, here's the first time it happened. I'm not saying Ryan is calling for markets to go up or down. He's just showing the data, and he does a good job doing that. But like all this stuff, it's like, oh yeah, I never really see when it doesn't happen. So, all right. So that's pretty good. The other thing too is, let's see, Shane, you did a little bit of research, or you found somebody's research.
No, I did this.
Okay. This looks AI, but tell me what you did here.
Okay. So basically, a couple weeks ago, some of these data points you pull are fascinating, and I got to thinking, we closed.
But you're not that interested. It's okay. You can just say.
Yeah. 5 consecutive closes took place below the 200-day moving average on the S&P 500 in late March. March 25th, to be exact, was the 5th consecutive close below the 200-day simple moving average. Over the past 26 years, this has occurred. Prior to this, 10 other times. Of those 10 times, the average return after 1 month is negative 5%. And we'll get into this in a second. But over 3 months, it's positive 2.1. Over 6 months, it's positive 9.81. After 12, it's positive 11.2. The biggest noticeable sort of thing that points out in this data to me is that after 1 month from that close of a 5th consecutive day below the 200, there's only been 2 occurrences in the 10 points in the data set where the market was higher than it was at that time. That was October 26th of 2023 during the 10-year yield spike scare, which sorted itself out, as we know. And the only other occurrence was actually November 14th of 2012. There was a fiscal cliff panic that seemed to resolve. The returns after those 2 years were pretty impressive. October 2023 being 38.5% above that 5th day it closed below the 200-day, and then in 2012, 28% above that level. So, who knows how this plays out? And again, this could break and not hold true, but at least over the past 26 years, this has only happened 10 other times. And any time after a month it's up, it seems to be up 6 to 12 months after.
Well, I'm looking at the data, and you focused rightly on the 1 month return. I think that's an interesting data point that most of these are negative. Okay, so that's an interesting data point. 6 months later, all but two were positive. All but two were negative, and 1 year later, all but two were negative. The two that were negative, financial crisis. So the confirmation, day 5, was November 15th of 2007. That's before the GFC, 2008, 2009.
Yep.
And the dot-com burst. So April 20th, 2000. And basically what this tells me, without even, if you didn't know any of these, you would say, which of these occurrences, COVID-19 crash, China devaluation, fiscal cliff panic, 10-year yield spike, tariff shock, blah, blah, blah. And I'm not dismissing it. I'm just saying all of those, but financial crisis and dot-com burst did not have recessions. And basically what this goes back to is if you don't have a recession, typically these short-term pullbacks wind up being buying opportunities at some point. But if you do have a recession, and this is the challenge, because when we look at stuff like this, you just don't know, are we going to have a recession or not? In 2022, a lot of people, remember, starting 2023, 29 out of 30 leading economists said we were all but assured to have a recession in 2023. We did not. The bear market ended and we went higher. So, yeah, I mean, Shane, I would almost look at this as when you have these, typically the market's higher, but for a recession. And Mike, that's the thing in looking at these. I guess we don't know when a recession will come. But the dichotomy, I'm curious what your reaction is to the research that Shane did here, is that 1 month later, it's not great. A year later, it's pretty great, but for recessions.
Yeah, I was a little surprised about the 1 month return, just because we have seen so many V-shaped recoveries, I feel like, recently. So the one month return was surprising. I think you're right. When markets sell off, and these are substantial sell-offs, they tend to recover and then some. And so that's, markets tend to go up, and that's why you see these outsized returns, because it's making up for those, that downturn that it had. But you're right. You don't know when that recession is gonna hit. That's going to extend the losing streak. Extending the losing streak is an even better buying opportunity. It is a recession though, and it's about the time that you're in the recession that matters. So you don't know when the recession is going to come, and those are the outliers in this data.
It is fascinating. What is it economists have correctly called? I'm making this up. 50 out of the last 3 recessions or something like that.
Right, like the yield curve inverting, right? The yield curve inverting is 15 out of the past.
All right, so Shane, when can we say that the yield curve inversion didn't work? Like, what's the statute of limitations now? Are we past the point where it would have worked? Can we just say it didn't work, or do we have to give it more time?
No, and this goes back to your book. You wrote a wonderful chapter in your book.
Thank you very much.
Bonds. Yes, it's so good. It completely changed my outlook on how it all works. And yeah, I mean, I think eventually the market, the global, everybody, it's just realized that, look, you gotta put your money into things that actually make money. And the U.S. government doesn't seem to really be one of those. Is it a good spot to maybe store some cash, and it's a little more safer and it serves its purpose in certain areas? Absolutely, right? But at the end of the day, you got to own assets, and government debt, it is an asset, right? But there are a lot more out there that have a lot more potential upside.
I would say too, Shane, the point of the chapter of the book, and I think I'm doing this from memory. I did write the darn thing, but Broken Pie Chart available on Amazon or fine bookstores, or not fine bookstores. You can buy my book at a not fine, a shady bookstore too. If they have it, buy it. Maybe it will be cheaper. But I think the point of the chapter was bonds' future performance can't possibly equal the past. And the reason is rates were so low. The sensitivity to changes in interest rates was so much higher than it is when yield to maturities on bonds are higher. And so the point was, like, you're near zero yields, or, people forget, we were under 1% in the 30-year treasury. When rates go to 5%, Like that is a massive move. I think people, if you bought 30-year treasury bonds right before rates rose, I think you're still down something like, 40%, 50%, even on a total return basis. I'd have to look it up. But yeah, I mean, like, look, we use bonds as a funding source. We use bonds in portfolios. They definitely have a place. But I think, and this came up this week at the conference, there are a lot of people who do back test or they do financial modeling for portfolios, and they use 40 plus years of a massive bull market in bonds to get average annualized returns. And the point of the chapter was like, we're just not going to see that. We're just not. I mean, rates in 1982, you could have bought a 30-year treasury for like 17% coupon. That's not happening. Or if it does, it's going to be really painful to get back up there. So, all right.
Wouldn't you say markets evolve, right? Isn't that the point of markets? Things change. So
I'm just saying that like you can't expect to have the annualized returns that you did, because not only did you get the coupons, but you got all the appreciation. Interest rates go down, bond prices go up. And when rates were zero, I don't think rates are going back to zero. But when rates were zero and they're lower, you have much more risk when rates go higher. In the 70s, and this is in the book too, the losses on holding bonds were less because you started off with coupons that were, 6%, 7%. And so when rates went to where they went, the math just says you don't lose as much. But when you're at zero, you're getting into bond convexity and things like that. All right, let's do another hour on bond convexity. Sound good, guys?
Great.
All right. I think we've... so let me ask this. Shane, you first. Let me think. We closed today, S&P 500 index, 7126.06. So let me do some quick math here, and I'll ask you guys. Do we hit... I'll use even numbers. Do we hit 7,600 first? Or do we hit, what did I say? Yeah, 7,600, or do we hit 6,600 first? Over the next, I got to give you a time frame because that's fair. Before now and the end of the year, do we touch 7,600 first or 6,600 first? And it's not saying where we're going to end the year unless you think we're going to touch one of those levels, in December. Shane, what do you think?
You're going to hate this. I think we're going to touch the 66 first, but I think we're going to end up at the 70.
Okay.
I think that I could see Q2 going great, us hanging out up here for a while. I could see Q3 pulling back hard a little bit, and then you catch a big bounce into Q4.
So that would be a 7% retracement from here.
Yeah, I think that would be fine. Yep. And then everything calms back down, and then we end up on the highs near the end of the year.
Mike?
I'm going to go with 7,600. I think the path has been cleared. I kind of want to say neither, but I see more of a path to 7,600 than back down.
I guess neither could be a choice. You could be inside both of them.
It's like a 6% move higher from here, or 7% move lower, right? Yeah, I mean, I would go with 7,600.
Do we touch 8,000 this year?
I don't think so.
Hey, if you could know this prior, you're up 3.9% year to date. Does that change your take? I mean, that probably reinforces yours, right? We said, 6% higher, up 3.9%. There's your 10% annualized.
Yeah.
All right, I'll throw some. And by the way, this doesn't impact any of the way we run the strategies. Like the core thing we do is buy and hedge, buy the market, hedge the market, buy the market, buffer the market, and then we have different strategies that we use. A lot of them are hedged. A lot of them are putting assets together, which don't all do the same thing. I'm going to say we hit 7,600 first, and I think we touch 8,000 this year. I'll probably be way off.
Was that Oppenheimer? No. Oppenheimer said like 8,200, I think, at the beginning of the year.
Oh, I should have gone 8,300. I want to beat them.
Right, of course. But it was really funny. And you remember, I'm sure you remember, I said we were going to have a horrible down year, right? Of course, I had to be the one person here to do it. But that was my kind of thought, was if we don't have a terrible down. I mean, we could. Thank you, Mike. Thank you. We could. But if we don't have a bad down year, I don't see why we don't have we gotta have a big up year. There's no, who knows? So
that's, if it gets to 88,000, it's 12.26% higher from here. And
15% on the year, 16%. We've done that before. So it's doable.
Well, the market never gets the average.
Right. The average 10%. We never close on 10%, right?
Normally, a lot of analysts, and I remember this back from the 90s when I worked in New York City and talking to analysts, they'd be like, oh yeah, I just throw 9% on whatever the market closed last year, and that's what it will close next year. Like, that's how they did their picks. So where do we close December 31st? One of these weeks we'll actually do a ton of prep, and we'll have all the data here. So, but let me see. Where do we close? We close December 31st, 68.45.50, right? So 68.45.50. If we 68.45 spot 50. Yeah, you were right, Shane. You did the math. 16.87%. If at some point we touch 8,000. And in an up year, that's not unheard of. So, Mike, your prediction of probably be inside those numbers is the one we're not thinking of,
and is Mike, the least likely.
You're selling the straddle, Mike.
Yeah, you're selling the straddle. All right, let's get to some recommendations. I already gave people draft day. If you're interested in the NFL draft, Kevin Costner. Oh God, why can't I? Really good actor. He passed away. He was in Black Panther. He was in that movie. What is his name? Why can't I remember his name?
Chadwick. Yeah, Chadwick Boseman.
Yeah. He was in. He was good in that. He was like the Mercurial.
He did the Jackie Robinson movie, right? 42.
Oh, he did do that. He was with Harrison Ford in that, right?
Yeah, that was so good. Yeah.
All right. But I like Draft Day, Kevin Costner. We live in a different world than we did just 60 seconds ago. You'll know that if you. So let me think of my other recommendation. Mike, let me go to you next.
Full Swing just came out. It's a documentary on Netflix, sort of like a behind the scenes of I don't know how many golfers they follow, but professional golfers. And this should be a good one. It's going to include the Ryder Cup, which had a lot of drama. And it's fun to follow some smaller name players who are sort of just, scraping by to even be on the tour and see the different lifestyle those guys are living versus the top players. So I think this is the 4th season that they've done, and the previous 3 have been pretty good.
It is interesting how the caddies sometimes bum a room off somebody.
Yeah.
If you're not caddying for a golfer who makes a lot of money, they really don't make anything because they get a percentage of the pot, right?
Right.
Yeah, it's interesting. Is Jordan Spieth in this one?
I believe he is.
I still can't believe, I thought he would have won major after major.
I know.
It was that one Masters where he kind of, I'm not going to call it a meltdown, but he put the ball in the water. It was a meltdown, you think?
Yeah. Okay. I mean, he put it in the water twice, didn't he?
Yeah, he may have. I kind of root for him. I want to see him win.
Yeah.
And when he can putt, when he won that British Open, his last major, his putting was flawless. So I kind of root for him. Shane, what do you got for recommendations?
I've sat on this for a week now, and I wanted to tell you, and I just saved it for this. It's
Okay.
gritty. You know, it's crime. It's a rough movie. I watched it for the first time. Serpico, so good.
Oh, of course. I know Serpico.
And probably all of our listeners probably know it too. They're like, "What is this kid recommending?" Right? Give us something new. But I just, it was incredible. It was such a good movie. So I told you, there are movies out there that are classics that I've given myself the chance to not watch. Good Will Hunting was one, right? They don't make them like they used to. They just don't.
So Serpico, Pacino was nominated for Best Actor by an Oscar. Did not win. He finally won for Scent of a Woman, another kind of classic movie. But yeah, Serpico was great. It is a rough stuff movie though. Like,
I didn't know it was based on a true story, and I'd known some stuff from pop culture from it, right? Like I'd seen other shows or things almost.
Yeah, the cop who he wrote a book.
Right. What I forget what law or something got put in place in New York because of it. Like something, some investigation. The Knapp Commission. It was the Knapp Commission, is what that was. But yeah, great story, great twist.
Have you seen Dog Day Afternoon?
I have. That's actually one of my favorite Pacino movies.
Okay.
Not nearly as pop. That's a classic too.
And Justice for All, that's another classic during that time.
I have not seen Justice for All. So there we go.
Where he's screaming at the judge, "You're out of order."
Oh,
I'll think of some other ones for you there. That's those some classics. So no, that's a good one. People haven't seen that. It is a little bit of a rough subject, but it's classic Pacino there. All right, I'll give you one more, just because I didn't plan on mentioning Draft Day, but Nuremberg. So on Netflix, I was on a plane this week. I downloaded some stuff. I watched Nuremberg. It's got Russell Crowe and Rami Malek, and it's about the Nuremberg trials. So I thought it was pretty good. It was like well acted, good movie. Tough stuff, by the way. Probably not great subject matter, but I thought the acting in it was pretty good. So that's on Netflix. I'm a fan of Netflix. They give me all the episodes I want, whenever I want, and they put movies on there. This is just a movie. No commitment. 2 hours, you're done. So I like that. All right, guys, we did it. We'll see how much we got wrong this week. I'm sure we'll get wrong a lot. And we'll check in with everybody next week. See you, everyone.